Hey everybody, welcome to the webcast. This is Shane Smoleny, and I'm going to be doing a webcast today about the Fed juice and kind of where it comes from and what's going on right now with the markets. So I know some of you are uh, longtime subscribers and some of you are new and some of you aren't subscribers. So what I'm going to do is give you a background. First of all, can everybody hear me okay? Just type in the chat if you can hear me. I just want to make sure that this is streaming through. Can you hear me? Just type in if you can hear me. I'm just going to type in, can you hear me? So we'll just wait here just for a couple more minutes till some more people come on. Okay, great. Hey, Ron, glad you made it. Okay, all right, so let's get started with this webinar. So each week, what I'm doing is I am Vegas Salin. Okay, great. Each week, what I'm doing is I'm going to be doing a webinar on a different topic. And some of the topics you might find interesting, some of the topics you might not. But I think a lot of people find the Fed interesting because since 2009, the markets have been in this expansive bull market until very recently with the COVID-19. We just saw this big first crack in the markets, and then it's had this big recovery bounce where it's all the way up to 78% of the off the lows. So what I'm going to do here is I'm going to give you a background on the history of the Fed juice. The Fed juice is a generic term that I use for the way that I monitor operations of the Fed, and I'll give you the history of this as we go through the presentation. But there's multiple operations on multiple time frames that I track. And together, when I put them all together, you get a very clean indicator that forecasts the S&P 500. And so I've taken this Fed juice and I've also taken it many more steps into indicators and correctly pricing the S&P, correct valuations. So there will be more videos beyond this with the Fed juice. This is just a start on the Fed juice. So um, I just wanted to start with that. So I want to read you a disclaimer first. So trading commodity futures involves substantial risk of loss. Past performances are not necessarily indicative of future results. Services include products that are traded on margin and carry risk of losses. The products may not be suitable for all investors. Please ensure that you fully understand the risks involved. Wolftrader Futures is an educational service that is designed to be a supplement to the book A Trader's Guide to Financial Astrology by Larry Pesavento and Shane Smoleny. Wolftrader Futures is separate from Mr. Smolen's firm, Trading Ridge Analytics, LLC. The information and strategies presented in Wolftrader Futures are completely independent of any strategies or operations employed by Trading Ridge Analytics. So I have a firm, I'm a registered CPO and CTA with the NFA, and that's Trading Ridge. So the idea of this is just to tell you that the two have nothing to do with each other. And the idea is just to keep it separate. For investors in my firm, that they don't feel that I'm giving information that's relating to any commodity pools to this newsletter. So these are separate events, and this is really my area to do research. This is my area to shine in terms of research with the Fed and research with astrocycles, and so that's what this service is about. So this is really a very fertile breeding ground for ideas and concepts, and we're constantly evolving. The data used in the creation of astrological planetary data, charts, and cycles is public information as already reflected in the underlying futures price. So the idea there is that everybody gets the same information at the same time. It's public information. And I always like to start with this slide here. I have a charity drive that I run. This is for the Camilla's House for the Homeless. This is in Miami, Florida. And so this is a shirt, Follow the Fed, on the front, and on the back, it's Wolftrader Futures. So I'm probably making more of these shirts as they gain in popularity. I might have Follow the Fed juice, but this is 100% to charity. So you can look down here on the actual, this Teespring here. You can look down here and I send 100% of the proceeds to charity. I don't even see a dollar of this. It goes straight to the charity. So you're doing a good cause there. And we're also promoting the service here, which is good. I think it's important to spread the word about what's going on because one of my missions is to educate you guys on the markets, to give you an idea, to make sense of what's going on in the markets, because there's so much craziness these days with the markets that a lot of times it doesn't make sense to people. If you're new, I have a website, wolftraderfutures.com. and there is an email list. So make sure that you sign up for the free email list if you haven't. If you sign up for the free member service, you will not be on this list. So this list will give you updates on new products that are coming out, new ideas, webinars, whatever it is. This is where you need to be if you want to get on that list, if you want to know what's going on, okay? So I'm going to be bringing this list back up throughout the presentation because people come in and out of these presentations. So just to remind people. So let's just go through real quick Wolftrader's futures for those of you who don't know. The idea is that we make sense of financial markets for investors. So again, I want you to be able to look at the market and understand what is going on. Why is the market rallying in this COVID crisis? Why did it rally so hard when everybody thought we were going to go into a depression? Why did it rally? Well, I clearly point out that this is because of the Fed, and I showed everybody this. We educate investors on planetary cycles and the influence. So planetary cycles is when we talk about cycles involving planets, weak statistics, that I educate people on how this works and how the market works with this timing. But we also use the impact of the Federal Reserve. Now, this is really important because we're the only service that offers integrated analysis of the Federal Reserve and how it affects the S&P 500. You will not find this information on any other service, I promise you. This is one area that our service is completely unique and independent. I mean, you might find planetary cycles on other services, different lunar, solar cycles, but you're not going to find the Fed. This is where we shine. We give you the highest probability alignment. So I line up the astrocycles with the Fed and statistics to give you the best windows. And of course, we strive to provide customer service and answer all your questions fast. So when you sign up for the website, even on the free service, you can chat me on the website and I'm able to answer your questions pretty quickly. Again, for those of you who don't know, I'm a bull on the S&P 500. I've been a bull the whole time. There's never been one time where I looked at the market and I said, oh, wow, this is going to crash. We're going into a depression. Nothing like that. In fact, on March the 20th, when the market was crashing and everybody was running for cover saying this is a depression 2.0, I clearly said that I did not think we were going to crash, and I thought we were going to have a full recovery on the market. Okay, so this is a stance that I still have. I still think we're in a long-term bull market. I think we could have some some short-term bumps along the way, but I will begin to show you in the coming slides why I think that's the case and why I think that this bull market is likely just getting started. This is the Fear and Greed Index. This is CNN puts this out, and I really like it because it gives a sentiment indicator of the markets. Right now, it's pretty neutral. It's around 52%, and it really hasn't risen that much during this recent rally, which is typically a bullish sign for the markets, so that's good. And Fear and Greed Index, this is the same chart, but it's just showing the relative peaks and troughs. So we had a peak here in January at all-time high, and then in March, we had an all-time low. So when people get too excited about the markets, it's time to sell. When they get too depressed about the markets, it's time to buy. And we came up right past 60% into here, and now we're kind of just in this mid-range here. So this is nothing too crazy on either side of the market. I know many people are hyper polarized. Some people are hyper bullish. Some people are hyper bearish. But I'm going to just try to make some sense of these markets to you in a neutral perspective. This is another thing that we watch, the planetary speed index. We're coming off an important low here for the year. Another one is later in November. So, we did have this sell-off, but it was in line with that planetary speed index. But this video is not about the planetary speed index. It's about the Fed juice. This is a chart of the S&P, just a bird's eye view that even with this big COVID sell-off like this coming down and then bouncing back up, we still look very, relatively stable here on the 200-day versus the 500-day moving average. And I like these charts. Moving averages get a bad rap by people, and I don't necessarily trade by them, but I really like to get a big view of the markets because it's showing me that this is still in a relatively bullish profile. And even with that big dip, we still had this nice separation here. And in general, that's a good sign for the S&P. So I just wanted to give you a little bit of perspective there on the S&P. Again, for those of you who just came on, you can go to the website, the free email list at wolftraderfutures.com, and you can get on that free email list if you want to get updates. We also have a Facebook group, Wolftrader Futures. You can go there and sign up. So go ahead and go on over to that Facebook group and sign up because I'm able to post more there than I am on Twitter. I also have a Twitter Wolftrader. I'll tell you the two. Let me just write this out here just real quick for those of you who are new. Wolftrader Futures. There's a lot of copies of my site, so I don't want you to go to the wrong one. We're the original Wolftrader. Okay, wolftraderfutures.com, and then that's the website, and then the Twitter is going to be @Wolftrader FUTU1, and then the Facebook is just going to be Wolftrader Futures. So make sure you have the futures there, or you're going to go to a bunch of strange sites that aren't the real thing. This is the real thing. We have the real Fed juice. I know a lot of people try to copy it, but we're the only ones that have it. So you can take a look at those different areas. I really like the Facebook because, like I said, I can write expanded messages. I can chat with people. It's much more interactive. But these other ones will do too. But I think the Facebook is a good one. You get the first notifications there. So let's begin here. Let's start talking about QE in the market. So QE was a program that the central banks began to try to save us from the Great Recession. And it actually began in the fall of 2008. Not a lot of people know that. And it had a lot of starts and stops. And originally it didn't have an end date. And then they had an end date. And then first it didn't even have a name. They just started buying bonds. And, then in November they named it. And then in March they expanded it. And it just kind of was like this thing that took on its own life. And the market, okay, so this began in the fall of 2008. Then the markets bottomed in March of 2009, as we know, right? And this was back in a time before the Fed really had started dominating the markets, that a lot of forecasters that used, Fibonacci extensions, Elliott wave, even models like the Bradley barometer, they were able to forecast this bottom because the market was still relatively playing out the natural cycles of the universe, okay? But ever since then, the Fed came in and has started to dominate these markets. So when the Fed comes in heavily, the cycles tend to back off in importance and the Fed takes priority. So you have this battle between the natural forces and the Fed forces, okay? So the natural forces are like natural cycles of the universe and solar cycles and lunar cycles. And so a lot of people had very good success forecasting the market pre 2009. But then the Fed comes in, and when the Fed just starts juicing the market, these indicators tend to take a backseat to the Fed, and the Fed begins to just dominate the show. And so it was around this time that I started to really study the Fed because what would happen is the cycles would stop working and then the Fed would take over. And then when the Fed would stop, the cycles would start working again. And I couldn't understand what was going on because we had never seen anything like this. Now, for those of you who have a lot of experience with the markets, maybe you've looked at the markets for 40 or 50 years, I will just tell you that we have never seen anything like this. So if you have experience in the markets or you're using cycles from previous years, I contend that first of all, it's important to educate yourself about what's going on here with the Fed. And secondly, that those cycles may have shifted through time and now everything is new from 2008 forward. So this is why I really focus on the time dates from 2008 forward. So anyway, so getting back to this timeline, so the Fed tried to sell off the bonds in June of 2010, which I'll get to. And that was Bernanke's first lesson about his first mistake, what he learned about the markets. And then they begin to go on from there. So I'm going to give you a little bit of a history lesson here, and then also give you my perspective on how I learned about the Fed and the importance of it. So this is the Fed juice here. Now there's different levels of it that I track. Okay, I track daily levels, weekly levels, and there's different maturity dates, there's different operations, but this is really a conglomerate that I use to track. So this chart here, we're going to go back to, this is like 2008 here. And so this is the Fed juice here as it rolls, and these are different time frames here, okay, because a lot of these bonds have different maturities and expirations. So what happens is to properly graph this, you have to include all these different time frames, okay? So this is when QE1 started here, and you can see the market was crashing, and the Fed starts this program. And notice they did start before that November, by the way. They just named it in November, and then the markets start. So the markets had stabilized. So this is the March lows of 2009, and then essentially markets started rallying, right? And so this was a period here. This red box. This is when Bernanke said, "Well, quantitative easing is over. I can just start selling off the balance sheet." And so what he did was he started selling off the balance sheet, and the market started to crash. They started to founder. Okay, so they went up here, and he started in here. He tried to sell off the markets into here, and every time he started selling off the balance sheet, the market started plunging. I mean, they started going straight down. So this is where Bernanke learns that that this is going to be a permanent thing. This is his moment in 2010 where he's realized he's like, oh my God, we cannot ever sell these bonds off. Like we might be able to let them expire, but we're not going to be able to sell these off. Now, this was a time when all of these bearish people were looking at the market and they were saying, oh my God, look at this. This is a head and shoulders pattern. The market's going to crash. We're going to go straight down. And the world was putting out forecasts that the market was ready to crash. I mean, in these Elliott wave people, a lot of them are, are bearish. There was one Elliott wave guy, Anthony Caldero, who passed away recently, but he wasn't. He was the only one that I know of that was correctly calling this. But the point is that this is where the markets ceased to be under like a natural law, and the Fed started coming in because at this point Bernanke came in and says no more selling. In fact, we're going to ramp up the purchases at this point. We're going to buy even more. Okay, and so the QE1 was like in flux all the time, and then the market started going straight up. Okay, and so this is really where the sanity in terms of forecasting ended, and all all the cycles, all that stuff went out the window at this moment here. So this was a big moment of history, of destiny here. Bernanke realizes he can no longer have his dream of just selling off the balance sheet. In fact, he's going to have to keep expanding the balance sheet. So the market goes up. Okay, and now he started to, this is where he expanded, but it started to kind of drift off here. And I think he says, okay, well, we've had a long enough period here. I'm going to end QE, but we're going to keep it on the balance sheet. We're just going to keep those assets, and they're going to eventually expire, the longer maturity dates, and then QE1 ends, and the market starts to founder. So I started looking at this, and I was like, oh, that's weird. Right when it ended, the market starts to have a lot of problems here, right? And by the way, this is a period where the astro cycles started to work again. Everything started to work. All my forecasting started to work. Everything. I had a newsletter back then. I was sending out everything. I was picking these tops and bottoms to everything was working perfect. So why did it start working here, but it didn't work here? Because of the Fed, right? Because this is artificial forces on the market. This isn't real stuff, right? So I was like, okay, so let's go. So QE2 starts in 2010 or 2011. Let's just say 2011, and fall of 2011, June of 2011, and there was a major top forming. Okay, now when this major top formed, I think my connection's going in and out there, guys. Sorry about this. Hopefully I'm back online again. Okay, so a major top was forming here, and the astrocycles started to work again. So at the end of June of 2011, the astrocycles started to work again. And I was like, this is weird. All of a sudden, it's starting to work again. I'm able to forecast these markets. What's going on? So this is where we were. So I'm going to show you, this is QE2 starts here. This is 2010. Now, I want you to notice something here. I want you to notice this white part here is the market. This is the S&P 500 here. I want you to notice how cleanly this follows. The market starts to follow the Fed. So when the Fed pulls back here, the market pulls back. You see that right there? And then the Fed ramps up the juice here, and the market goes up here, right? It's like a perfect footprint of what the Fed is doing, right? It's like, okay, whatever. So the Fed pulls back here, the market starts pulling back, right? Market starts pulling back here, right? Now, QE2 starts ending around this period, okay? So the cycles were not working so well into this period, but the Fed was starting to pull back. QE2 ends, okay? So for those of you who remember, I had a newsletter back then, right? The newsletter back then was nothing like it is now. I mean, back then it was like 5 pages, right? Now my newsletter is like 40 pages, right? But this is a chart that I put out, right? So I started to see that there was some relationship here, right? There's a relationship here between um, the QE1 here. The market went up there. This is when the Fed tried to reduce the balance sheet. And when the Fed ends the QE, the market starts to fall, right? Okay. And then the Fed starts again. Okay. And then market starts to falter here. So I said the Fed ends QE2, equity stall. So I started to understand, at least in my mind, that, hey, look, there's something here. Like when the Fed is doing their thing, the market's going up, the Astro stops working. When the Fed stops, the market stalls. Okay, that's what I knew at that point. And then the Fed's operations were relatively simple at this point compared to what they are now. But I was like, that's weird. And then the dollar started falling, so I put out I had a newsletter. Okay, so this is the actual newsletter from 2011. So keep in mind the Fed was not active. The QE2 had ended, and I said, the combined cycles have peaked. I put this out. I announced it. I told everybody. I said we are at a peak here in the S&P. I had combined cycles here. I said we're at a high. This thing is going to go down. Okay, this thing is going to crash. Now, the way that this stuff works when you forecast things. Excuse me, guys. I got to get a glass of water here. The way that this works when you forecast things is that when you say the words crash, when you say the word crash or the market's going to crash, everybody tunes in to see it, right? Nobody wants to see positive news about the market. I don't know why that is, but when you say, oh, crash and the end of the world and all of this stuff, everybody tunes in, right? Everybody wants to know, oh my God, is the world going to end? And so you get into this vortex of fear. I don't know what it is, but people make a lot of money by telling other people that the world's always going to end. So, but I was like, okay, I didn't really understand that what was going on, that the Fed was out, but I was like, look, I have these cycles. I'm pretty good at this. I feel like I can forecast this. We're going to go down. Okay. And I told everybody this, and I gave them a date. I mean, this wasn't just like I'm pulling something out of the air. It's not like we were just at overbought. I actually could give you a date, right? When I looked at the astro cycles here, okay, this is like, this was the real thing, man. This is what I do. I'm good at this, right? I know how to track these transits. I gave a date. I said August the 9th. That's going to be the low. Okay. I said, we are here. We've got this big declining market. And, we had the Mercury station. Mercury was making that station, the plus or minus 3 days. I told you that's always a crash. And I said, look, I put everything into these combined transits. By the way, this is still in the newsletter if you guys want to see it. And I was like, look, we're going to go down to August the 9th, right? So what happened? What did the market do? What did the market do? Well, here's what happened. The market went straight down into August the 8th. You see this right here? August the 8th. So I was one day off on this, okay? And I believe at that point that the Fed was already in there messing around. There's no doubt in my mind when we started to see these gyrations into here. So I told everybody, I said, we are here, right? I told everybody that. I was like, we're here. And I felt at that point that I was getting pretty good at this forecasting, right? I didn't understand still what was going on with the Fed, didn't understand it, but I knew that my forecasting skills were getting better. I was able to see the cycles. I was able to see the transits. I didn't have the planetary speed index yet at this point, but I was like, hey, we're going to make a low on August the 9th. It went down to 8.8. That's it right there. Okay. I was one day off, and I still believe the Fed was in there. Okay. When we start to see this nonsense into here with the crashes, that's usually the Fed coming in and making it hard for people to short. Okay. So that was a time when I was like, okay, I'm back. I'm back. I got the forecasting back. I can do this. I can forecast this to the exact day. It wasn't luck. I picked the day, et cetera, right? So then they start up with this Operation Twist, and the markets were kind of going in path, and we started to get this decline into here, okay? So the Fed just was going down. Then this was like Thanksgiving, okay? I remember this. I was walking around Disney World. It was Sunday night. I was with my family, And I look at the phone, and we're driving home, and I look at the phone. I see the futures. They're like straight up, like limit up, like straight to the roof. And I was like, what is going on? And this is when the LTRO started, the long-term refinancing operation. This was a European QE. So this was Europe. And the thing that made this one really maddening to me was that Europe is not, they don't have the same standard that the US Fed does. The US Fed tells you what they're going to do before they do it. Europe, they did the opposite. They did all this backdoor lending, and then they told you after it was over what they did. So you couldn't really understand what was happening, but I could see very clearly here that the market was not responding anymore to the Astro again. It just ignored it again. So I was back to this place again where nothing worked in terms of the Astro, and it just went straight up all the time, right? And then you can see here that's modeling the Fed juice again. You see the Fed juice starts rolling over here, the market starts rolling over here, right? And the market went up a little bit more, but eventually it did come back. So you can see that once again they flick the switch, and the market goes up, Astro stops working, okay? So at this point, I still didn't have planetary speed index. I still didn't understand how to track all the operations, but I was starting to see like, okay, because I was feeling real good after this. I was like, okay, I got this. But then I started to see, well, wait a minute, something's going on here. And this time it's with Europe working with they were working together. There was an announcement that they were working together on this, but Europe did it backwards, and they weren't telling you what they were doing until after it was done. So I couldn't track this, right? I just saw it going up into this zombie march higher, right? So anyway, so that was just like an introduction to how I got started with this. And then I started really researching this every day. I started looking at the data. I look at the spreadsheets. I look at the maturations. I look at the types of securities they buy. And this is kind of a timeline of what happens. So you have QE1, and then you have this stress test, which I'll show you. That was the one where Bernanke tried to sell off. QE2, Operation Twist, QE3. And then in 2014-15, there was a stress test. And then there was something called silent QE. There was a 2018 stress test, which was Powell. And then there was a reflation. And of course, we have the new QE4 now with, this super QE that we have, right? With all these new tools, the bonds, the mortgage-backed securities, the repos, the corporate credit facilities, the Main Street lending facility. The Fed has many, many tools now. And I understand what they're doing now. I understand clearly what they're doing when I see these operations. This is a bigger picture here, again, of just QE1, QE2, QE3, and you can see the outline beautifully of the Fed here and the markets. You can see how these markets followed up, and then this was when I made that forecast, and then the markets fell here, and then this fell here, and yeah, we hit that low, and then you can see it went up and it modeled it again. You see this is crazy, right? I mean, it literally follows what the Fed is doing, and I still didn't really understand at that point, but I knew something was going on. Okay, so here's everything together on the big picture. I went a little past QE3. Now you can see where we are, guys. So take a look back here, and then in that 2011 crash when we saw the Fed juice going up, this was QE1. The 2010 stress test, as I call it, that's when Bernanke tried to sell the balance sheet, and he realized he can never do that. He was like, the market was like, no, son, you're with me forever. You're, this balance sheet's never going away. Okay, and then here's the QE2. This is where I forecasted that crash. Look how low this is in this 2011 here compared to where we are now. Look how high that is, okay? We are through the stratosphere right now, okay, with this QE. So the QE3 ended, and then they did this stress test into here. Now notice when they do these stress tests, I call it a stress test because this is where you're going to see if the market can do it without them. Didn't work. Market pulled back, and then they started up again with this, what I call the silent QE into here. Okay, the market started to respond again. And then now this is what I'll talk about. This is Powell coming in here. February 2018, he comes in. He gets stubborn with the reverse repos. He's trying to take money out of the system, and he's trying to get those interest rates higher, and the market didn't like it. This was your December, this is the 2018 decline, and that was that big December decline. That was man-made, guys. That was man-made. That was the Fed. That was the Fed trying to, Powell came in, and to give Powell credit, he's doing a masterful job right now, and he learned his lesson. I mean, this was a lesson that he learned. This was Powell's lesson here. This was Bernanke's lesson here. Okay. He learned here that this isn't gonna fly. Okay. You're not gonna be able to take money out of the system to raise interest rates. It's not gonna work. And so he started up again with the silent QE. Okay. And they started ramping, and the market started responding again. Okay. And then of course we got the COVID here. Market goes all the way down, responds, and goes all the way back up to 78%. Okay. All right. So this is kind of a history of what's been going on. Now we're in QE4. I put this in bold here because on normal QE operations, you might see 5 billion a day. You might on a good day, right? This time on the big days, they had 82 billion. Okay. So this is like nuclear QE that they're doing right now. This is huge. Okay. This is a big deal. And it's necessary. Okay. And thank God that all of this happened, because they had a playbook when COVID struck. So they were able to come in and essentially rescue the markets. And they're able to do this with other operations. Now, for those of you coming in just now, I know I'm starting to see the views tick up here. There's a free email list on the website. It's wolftraderfutures.com. So if you go to the website, there's a free member sign up. You can go there to sign up as a free member, but you need to get on this email list if you want to get the updates, okay? Or you can go to Facebook, or you can go to Twitter, okay? Wolftrader on there's many different ways to reach us on social media, but this is where you need to be if you want to know what's going on in terms of updates and webinars. I'm going to try to do these webinars like once a week if I can. I want to keep the quality high with what we're doing, but I feel like I've got a few topics. I've actually got a presidential one that I'm going to do. I forecasted the 2016 election. I forecasted Trump's election, and I'm starting my research now on this next election and finding some very interesting things about it. So I'll be sharing that with you. I'll probably do a webinar on that. So let's keep going here. I know this webinar is going to be a little bit longer, but we have to get through this material. So this is when this is kind of a zoomed in view of Powell when he took office here, and he started up with all these reverse repos. So for those of you who don't know, reverse repos are a way that it's a tool that the Fed can use to raise interest rates when banks don't want to. So what's happening now is the banks are getting more independent and more stubborn. Okay, so it used to be that the Fed funds rate could just banks would follow whatever, but now the banks are getting a little more stubborn. So they come out with these reverse repos, and they essentially can give people better rates for their money. And what that does is that causes the money to leave the banks. Okay, so it's a tool that they can use to offer better interest rates. And the idea is that, there's two ways to look at that. One way is taking stress off the banks so they don't have to raise their interest rates. But another way to look at it is it's putting pressure on the banks, because they're kind of creating like a competition for the money that could pull money out of the banks. So there's different ways to look at this, but he came into office and he was like, okay, I've seen all these QE operations. I'm going to see what these markets can do on their own. I'm going to test it with these reverse repos, and I'm going to start cutting back on the balance sheet. I'm going to start letting these assets expire, blah, blah, blah. There's a lot of different things he was doing. But the point is, when he started pulling back on this, okay, he starts pulling back, it didn't take long for the market to completely founder here. Okay, so this was December 2018. This was man-made, guys. This was man-made. Okay, this was direct result of pulling too much money out of the system. So he was, he just comes into office. He's new. He's learning. So he learns an important lesson here. He's like, this isn't going to work. So they started up with this reflation again, and the market just immediately responds, right? So this is just a zoom in view. Now, I think Powell has turned into one of the best Feds we've ever had. I listened to him, and I think he's a master of his craft. I really do. I think he's learned his lesson from this point. And I think all of these tools that they're doing are important, because the banks don't always play ball. Okay. And the Fed is learning that. And the Fed is coming in with these new operations to help out in very specific markets. Okay. So before it was just Fed funds rate, Follow what the Fed is. Now the Fed comes in very specifically. Hey, you need liquidity with the mortgage backs? No problem. We'll buy them for you. These markets aren't functioning? No problem. We need to create a corporate credit facility? No problem. We need to create Main Street lending? No problem. So the Fed now has more tools to work with. So now let's talk about the weekly Fed juice. So the weekly Fed juice measures longer term operations, longer term maturities. And it's a good indicator. I found that it's a good indicator of broad-based market health. Okay, so since 2009, I found that this has been one of the best predictors of long-term market forecasts. Currently, the weekly Fed use is strong, guys. It's strong. It's strong. It's strong. So the point is, I've never seen this stuff fail since 2009, and I don't know why it would fail now. Okay, so in terms of the Fed juice, the markets are very strong and things look good. Okay, so I just want to point that out because you got to be very careful of this. I call this the vortex of fear. And so what happens is you get sucked into this vortex that the world's going to end and the market's going to crash and the banks are going to shut down and depression and all this stuff, right? Well, guess what? I don't think that's coming, guys. I don't think so. I think the central bank has figured out their role here in this. And it's an accommodative role, and I think it's a positive thing. And I think we're going to make it out of this. Okay, so I know a lot of people want to hear that things aren't going to work out, but I don't know why that is. But people get so obsessed with that concept of the world ending, but I don't think it's going to happen. Okay, so sorry, bears. This is the weekly Fed juice here. So you can see very clearly that this Fed juice is on these longer term operations is very strong on this market. And again, when I saw this rising and I saw the markets crashing, I was like, look, this is going up. I don't see anything here that tells me that, this market's not going to recover. It's going to recover. Okay, it's going to recover right back up with the Fed on the long term. Now you can see here, this was Powell here when he started with those repos. But again, the reverse repos, but the market rebounded. They reversed course. They increased the liquidity again. So, everything became good once again. So, yeah. So, I mean, on the long term, it looks good. So, sorry, bears. Now, could this stuff fail? Yeah, I could one day. I mean, I'm not saying this stuff can go on forever, but what I'm saying is I've never seen it fail yet. This is the market. It went past that 78%. I know it pulled back this week a bit, but it's surging nicely. I mean, it's almost back to the original highs, and so it's taken a lot of that fear out of the market, which is good. And so even if we just kind of flounder around for a little bit, that's fine. Um, this is another one that I've put out, and I was always talking about that we're in this bull market. So again, I still think we're in a bull market long term, based on this Fed juice, based on the operations, everything that I've seen shows me that this is strong. So, and it's also forecasting now that we're at some major lows, which I'll get to in a minute. So just to give you some perspective, I do track these in the day. This was back in March. And I was looking at the Fed, and this was like nuclear stuff here. This is like nuclear Fed. I mean, this is $82 billion in a day, guys. This is crazy. I mean, this is nuts. This is nuclear. And when I saw this, I was like, of course, they're going to put a low in this thing. It's not going to keep going down. And I track these, I go through the day and I track all these numbers, but this was crazy. I mean, like on a normal quantitative easing day, you're looking between 2 and 5 billion. This is $82 billion. So when I see this, I'm like, okay, that's a done deal. In my mind, it was at that point. And this is why I was coming out saying this. And plus, I track all the operations. This is just, you can't just focus on the balance sheet. I'm going to tell you why. Because the balance sheet is the net aggregate of holdings at any one time. However, that doesn't mean, like, you can be buying assets, but more assets can be falling off, and it looks like the balance sheet is shrinking, but you're still adding assets. So, these things fall off. They have maturity dates. Like some of them are shorter, faster than others. So this is a $31 billion day. This is another one that was very impressive on April the 6th. This was a week in April. So they started declining a little bit, but that's fine. I mean, these are still massive numbers. Anything above $1 billion is huge. for a day. I mean, 20 billion, 27 billion. So, these are very healthy numbers. And so just because the Fed has, let me point something out to people. Just because the Fed has come off 80 billion, 27 billion, 32 billion, that doesn't, it's still high. I mean, these were just nuclear numbers. This was a nuclear bomb, guys. This was a nuclear weapon that they were using, okay? So understand that. So don't look at that and say, oh my God, they're no longer purchasing $82 billion. The market's going to go down. That's not how it works. This is a typical day now, 6 billion, 8 billion, 5 billion. That's still high. So in terms of quantitative easing standards, right, that's still high. That's healthy. That's fine. That's great. There's nothing wrong with that. What's happening is right now is that those other ones some of them are falling off the balance sheet because they've expired and it looks like the balance sheet's going down, but they're still purchasing every day. That's still going on. It takes a lot to understand this, but I've been watching this for over 10 years now, so that's why I can tell you what's going on. This is an example of intraday. This was in March, so this was when the Fed was going absolutely crazy. This was the nuclear Fed into here. And you can see here that every time the Fed comes in, there's a green arrow down here. So every time the Fed would come in, the market would respond in turn. So here's the Fed here, market goes up. This is an intraday, by the way. Here's the Fed here, market goes up. 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 Here's a 24 billion purchase at the end of the day, market goes up. Okay. So there's nothing natural about these events. Right? This is not, you're not going to forecast this with a wave count or a Fibonacci or whatever. It's not, this is the central bank coming in and intervening in the market. So this is stuff that the only way you can understand it is to track the Fed. So this is why our subscribers understand what's going on. When you guys understand, I tell you guys very clearly every day, this is what's going on. This is what the Fed is doing. We're at a relatively high level, we're at a relatively low level. This is important. Now, you can use the cycles in harmony with the Fed, but if you don't understand what's going on here, the market, none of this is going to make sense. You're going to look at the markets, you're going to be like, this doesn't make sense. How can it be rallying? Oh, it must be the Robinhood traders. That's the new thing I hear now. Oh, it's Robinhood. It's these day traders. They're forcing the market up. It has nothing to do with Robinhood. It's the Fed. Okay. Yes, there's a day trading boom. I'm sure that people are trading, these small retail traders. That's great. Good for them. It has nothing to do with them. They're providing liquidity to the market. Okay, that's an important function. God bless them. But they're not the reason that the market's rallying. Okay, it has nothing to do with Robinhood. So every time a market rallies, when oil rallied back in the early 2000s, they were blaming the speculators. It has nothing to do with that. Okay, so this is, the markets move through by larger forces. In this case, it's the Fed. So this is a big question everybody wants to know. Are we in a bubble? Bubble. Everyone wants to know what bubbles. Bubble, bubble, bubble. Is the bubble going to burst? So sorry, bears, probably not. I'm so sorry, you bearish people out there that want this market to end. We're probably not in a bubble, okay? And I'm going to explain to you why. We're probably not in a bubble. Extended prices does not mean a bubble. Just because the market's high does not mean we're in a bubble, okay? So I'm going to give you an example here. The Fed is an artificial force. So if I'm just drawing a cycle like this, okay, I'm going to draw a cycle back and forth like this, right? And then let's say that I'm writing and someone comes and just tips my hand like this, okay? And then I keep going like this again, right? Somebody just tipped my hand and caused me to write higher on the page, right? And then they're just going to continue to go where it's going. That's essentially what's happening with the Fed, okay? This is not like a tulip mania where natural buyers and natural forces came in and caused it to go up and it crashed. This is the central bank coming in with a helping hand to help the markets out, to provide stability and liquidity. Okay, so this, just because the Fed comes in and now we're higher, that doesn't mean it's a bubble. Okay, sorry. I know a lot of people want the world to end, but it's not. Okay, so anyway, Fed bubble does not mean bubble. I meant to say Fed juice does not mean bubble. Okay. All right. So what's the point of all this? Well, we're able to price equities in terms of Fed juice. So this is when I talk about valuating the S&P, I evaluate the S&P in terms of the Fed juice. Like some people evaluate the S&P in terms of dollars, which is the normal price. Which is not a good way to do it, okay? Because you have the Fed that's artificially inflated this. Some people value the S&P in terms of gold. Well, guess what? That's turning up too. Okay. Some people value the S&P in terms of earnings. Okay, that's a little better. That's a fundamental. But I price it in terms of Fed juice, okay? So when you price the Fed juice and the S&P together, when you price the S&P in Fed juice dollars, okay? Fed juice dollars, the S&P is at a major low, okay? Now you would never know that by looking at the S&P because it's so high from where it was price-wise, but when you price it in terms of the Fed juice, it's at a low. I'm going to show you what I mean by that. So people are like, oh my God, how could it be a low? There's no way. It's all blah, 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 all-time highs. Listen, I'll show you in a minute. So what is the market? Real money is when you price it in terms of the Fed juice. So I'm going to go through this pretty quickly. But basically what happens is I price it in Fed dollars. Okay, so depending on how that's going, I come up with my own indicator and it shows me where we are. So the valuations are, they're low. Okay, they're below the March levels right now. Okay, so I'm going to show you on the chart here. So this is the Fed. This is the S&P and Fed dollars down here. Okay, so you see this down here. So you see how low we are. You see this line right here. This line, whenever we cross below this line on the Fed on the weekly time frame. Okay, this is a weekly time frame. Let's see. Okay, on the weekly time frame, when it gets below this level here, that's a low. Okay, so why should we care about that? Who cares? Like, oh, wow, this indicator made a low. What does that mean? I'm going to show you what it means. Every time it's done this, the market has rallied for two to 3 years. Okay, so this is the true valuation of the S&P as far as I'm concerned. This ultimate price out here, it means nothing because the Fed has come in and inflated these markets. Okay, so this is really what we have to watch as far as I'm concerned for low prices. Now, I know this is getting long. We're 47 minutes. Thanks for hanging in there, guys. I know these are the diehards that are staying for this. Anyway, this is the weekly Fed juice here. Okay. Now, notice this is the S&P here. Okay. This is the Fed juice here, weekly time frame, and this is the S&P in Fed dollars. Okay, in Fed dollars, Fed juice dollars. I'll call it that. Okay. So look. Every time it hits a low here, you see that? You got a big rally, 3 years. You see this right here? It hits a low right here, okay? 2-year rally right here. You see that? Okay, so guess what? We're at an even lower low than these points right now on the S&P in terms of the Fed juice. So what that tells me, if history continues to repeat itself, which I don't see why it wouldn't in this case, because the Fed is still operating stronger than ever, then this indicates that a rally is coming, not a decline. Okay, and I know we're still in the midst of the economy restarting and a lot of things like that, but this is indicating that we're at a low, not a high. Okay, at least by this measure. Okay, at least by this measure. Now, I will put a disclaimer out there: anything is possible on any day of the market. Okay, so we shouldn't become so overconfident in one direction, like it's going to go down or it's going to go up. Anything can happen. Okay, the market could still crash tomorrow or Monday. I'm not saying it can't. But what I'm saying to you is if you look at the past history, then this tends to show that the markets tend to go on these rallies. Okay? So, and again, it goes on and on and on, but I'm trying to keep this under an hour, guys. So, all right, so this is I'm getting near the end here. So this is a daily Fed juice here. So this is one that I show the subscribers all the time. And so just very quickly, this is the S&P in the white, okay? And I've numbered it letters of the alphabet, A, B, C, D, E, F, G. And then in the blue, this is the daily Fed juice down here. And you can see that the market is tracing out this very nicely. So when the Fed juice ramps up here, the market's going up. It models these tops very nicely, B and B here, C and C here. It models this. This turn here is modeled nicely. This little rise here was modeled, and then this fell. This one didn't model it here. But this rise here was modeled. And then this is the COVID here. So COVID here, market came right through that, okay? Boom, right? You see that right there? But the Fed was very steady with their hand, and they kept just increasing the juice. You see that? And then eventually the market did rebound up to those levels, okay? So they kept a very steady hand here. This is the first time, because the COVID was such an outlier event, this is the first time that that the market essentially led the Fed juice. Essentially, you see it let it down. That normally doesn't happen. Usually the Fed juice is leading first and then the market goes down after that. But this is the first time that the market led against the Fed juice. This is the first time I had seen that since 2009. It almost never happens like that. It almost always happens where, okay, the Fed is pulling back and then the market pulls back. But in this case, with COVID, the market, of course, led on the way down. And then we started this QE4, QE Unlimited, and we had a very strong Fed now. Okay. So anyway, I'm going to keep going through the slides here. So this is becoming long here. Okay. So, all right. So this is the last long slide, but it's important. Okay. I just want to emphasize some things here about the stability of the markets, why I think the markets are stable. The Fed continues to use more tools. Okay. I'm going to give you two examples here. One of them is the corporate credit facility. And this is on primary, which is initial bonds, and secondary markets, which are existing bonds. Okay, these are ETFs, existing. They can come in and purchase these. Okay, this is important. I'm going to show you a picture in a minute why that's important. Very important for stability. The next one is Main Street lending facilities, where they've lowered the minimum requirements for loans. They've made it so they don't have to start paying back for a year. They've made some very, very good terms here for businesses to help the banks, because the banks can't do the lending right now. The banking sector is struggling. So more tools allows the Fed to specifically target market problems. Okay, so now they have these specific tools. Before it was just interest rates, and then it was just buying bonds, and then now there's specific targets. So these increase the stability of markets and decrease the volatility because it takes the pressure off the banks. These allow the Fed other ways to control interest rates outside of the Fed funds rate, okay, which I'll get to in a minute. It's possible that there might be direct ETF purchases of stocks. So the Fed might come in and buy ETFs like the QQQs or the SPYs. That is not off the table. I don't think we're at that point yet, but that's not off the table. So this is just a headline. Nothing is out of the question. What would it take for the Fed to start buying stocks? So they were saying that it could come in the form of a big ETF that could track market indexes. We're not at that point yet, but it's a possibility. We're not there yet. Okay, so I just wanted to point that out. Now, this is really important here. So this slide, this shows you the importance of specific Fed operations targeting specific markets. Okay, this is the effect of the corporate credit facility. Okay, now this is a spread down here between the TLT, which is the long-term bond, the quality bond, and the high yield bonds. Okay, now why do we care about this? Well, and this is important too, because the Fed can now target interest rates using this tool. When the money goes out of the bond market and goes the high yield market, the junk bond market, and goes into the treasuries, this indicator crosses up. Okay, and that's okay in small amounts. I mean, the money can flow back and forth. But when you start to get a big spread like this, you start to get massive outflows from these corporations into the treasuries. Okay, and the problem with that is that now you have a very wide spread on this bond curve. And when you have a wide spread like that, there's no liquidity. Okay, and you start to see companies that are illiquid. You start to see bankruptcies. You start to see all kinds of problems. And if these corporations cannot stay alive, they can have to shut down, job losses accelerate, market losses accelerate. So it's a big problem. So the Fed came in and they said, okay, here's what we're going to do. We're going to start buying these through our corporate credit facility. And they announced this. And notice it gaps up right here. You see that? It's right there. So they're putting their faith in, they're putting their full faith into this. They're saying, okay, it gaps up. Now notice the spread starts getting narrower, narrower, narrower. Then This is really, really important, guys. This is like super, super important. Here it is. They start the purchases here. Okay. Notice right when they start, you see it starts going up like this. Now, what else do you notice here? Well, the bond starts to fall, right? And so now they can control the interest rates by the corporate credit facilities. And now look at this. So now it crosses back down again. That's bullish for the S&P. It's crossed back and forth a couple times, but now it's still in a bullish profile. So what have they done? They've healed the credit markets, okay? By providing a market there, providing stability there, right? And they've also keeping these interest rates from going negative. So they have all these tools now that they can go back and forth with the markets, and they can, on the one hand, provide stability and liquidity. On the other hand, they can maybe keep this bond market from running away to the upside, because they definitely don't want negative interest rates, right? That's not a good thing. So this is just an example of how a specific operation can target and help, okay? Now I'm going to close out with this slide here in terms of just where we are now. So this is the S&P 500. So just to show you, this is like the most difficult market to trade, okay? So the only way to really understand this is with the Fed juice. And so you can see here, I line up the Fed juice here with the planetary speed index here. And when the two of them are together, you get these I call them advantages, okay? So I know people do all their own day trades, longer, shorter, whatever it is. But I will tell you, when these two line up together, that you get an advantage. And that's what this green line is here. Okay, so I'll draw that in green so you can see it. So you see this right here? This was an upside advantage right here, okay? All right, so then it ended right here, and we were sitting out, and everybody was like, why are you sitting out? I'm like, well, there's no advantage. I only want to have the best odds in my favor. So the planetary speed index was in a sell, even though the Fed juice was up. So sat out, sat out, sat out. Everyone was like, look, it's running away. And I thought it might run up. I even said, look, it could be on a parabolic rise. But the point is, you don't want to be in the market when there's not an agreement, okay? So what happened? Boom, came down like this, all right? Then at this point, look, the Fed juice was still in a buy, okay? So right here, now these two are lined up again and had a little bit of a long trade right there. And now they're not in agreement anymore. Get out. So this is the idea of using the Fed juice to tell you, hey, look, you've got a tailwind here. And now you trade the cycles with this. You see this goes with the Fed juice here? You see this goes with the Fed juice here like this, and then it ended right here. So it's really like a guerrilla warfare at this point with these markets in the short term, because you want to line up what the Fed is doing with the astro cycles. And that's what we do here. And this is an example of a daily chart that I would post to explain to people, look, there's no advantage, okay? So I say, look, there's no advantage because you got one thing going one way, one thing going another way, and that's the idea. So, we put all this information together, and then we give you a nice summary there. So where do markets go from here? Well, there's a lunar eclipse coming up on July the 4th. And as I outlined in the other video, those can tend to be negative events. And I will talk about July more in the July newsletter. And then the COVID-19, there's a transit that I tracked when the global shutdown. And that's coming up in early August. So we will see. For those of you who are new, I have 4 newsletters right now. There's a 5th one coming out. So I have an S&P 500 newsletter where we track the Fed juice, and I give updates twice a week. There's a newsletter that comes out monthly. Next month, there's an energy newsletter coming out. People have asked about this. A lot of people write in. So if you guys write me in with questions or markets that you want to see, I can definitely look into creating a newsletter. So next month we have energy, which is oil, natural gas, heating oil, gasoline. We have the metals newsletter, copper, gold, silver, platinum. Currencies, which is the same as Forex for those of you who trade Forex. US dollar, Canadian dollar, euro, British pound, yen, and Australian dollar. And then the crypto newsletter is Bitcoin, Ethereum, Ripple, and Litecoin. And again, sign up for the email list if you haven't done so. And when you go to the website, you'll see just the covers of the different newsletters if you guys want to sign up. So there's also a Wix chat there where you guys can chat with me. You can check things out. ask me questions. It's pretty good. It's like you can download the app on your phone. So what I'd like to do now is show you the website here. So if you want to go, it's under pricing plans, and then you can go. You get a 7-day trial on all of these newsletters. So you can try it out, see what it's like. All right, so I'm going to go with this slide now. So I'm going to go into some questions. Does anybody have any questions about what I know we covered a lot of information here, but any questions on the chat? Can political party change affect this outlook? Okay, I'm going to type on this computer over here. Just give me a second. Yes, but not as much as you think. Okay, so the question was, can political parties affect the outlook? So my answer to that is yes, but not as much as you think. And the idea is that yes, of course, there's certain policies, fiscal policies that can affect um, economies. Okay, but right now with what we're dealing with the monetary policy of the Fed, that is really, really important. And so I would say that it's probably like 75% of what's going on right now would be the Fed. I mean, of course, it helps to have incentives for the economy, but not as much as you would think. Any other questions? Anybody? Elections. I started doing this election research, and it's really funny some of the stuff I'm seeing. It's crazy. Like I I made a graph of all of the presidential elections. I kind of made it into a chart, and so I'm able to track it. And I'm starting to see some trends that are pretty funny. But the presidential elections are, yeah, that's challenging stuff, guys, because you're talking about like it's a major fatalistic event when that's occurring. So it's hard to predict that stuff, but I can definitely try to tell you, um, major trends that I see, at least probabilities. I can tell you what the probability is. The thing about Trump is that people ask me about him is he has a heavy Uranus aspect. His energy is heavily Uranus, which is unexpected, and it's also that which challenges the institution. So anytime you have Uranus in the picture, it's very difficult to know what's going on. The same thing with Obama. He was the exact same. Believe it or not, these two look like completely two different people. But Uranus was going opposite of Saturn on the day that Obama got elected, and Saturn is the institution, and Uranus breaks up the institution. So we're in a Uranus vibration right now with the presidents. So Trump is a different type of a Uranus, but he's challenging what they call the deep state and the traditional, the media, the traditional forms of government, all these different things. He does things his own way. He's a Uranus aspect. So we're seeing in the presidential elections now heavy Uranus energy. So that can be a challenge. Okay, so how many days is usual solar eclipse effect? Um, I would say plus or minus 3 days on the solar eclipse. Somebody wrote that, so I'm just typing that in. So plus or minus 3 days on the solar eclipse. Now, let me talk about the solar eclipse here. Um, we're having a lot of transits right now. So, like for example, this week, like first of all, we have retrograde planets. We have retrograde Venus, and we have retrograde. I mean, all these different. Mercury went retrograde, and Mercury retrograde is generally negative for markets. Solar eclipse is positive. So I sent this out to subscribers, and this is, right now the Fed juice is down, so there's just nothing going on. But when you have so many events clustering like this, you really have to kind of weigh and balance, and try to align things the best that you can. It's like, for example, like the British pound. Okay, that's a good example because one of our subscribers trades this. It showed it falling for Mercury retrograde, and it showed it falling for the solar eclipse, right? So both of those charts were falling. Okay, so then in that case, it was very clear the British pound fell this week. Okay, according to those efficiency tests. But sometimes they're in conflict. Like the solar eclipse for the S&P says up, but the Mercury retrograde says down. So S&P's just kind of been going sideways right now. But I would say plus or minus 3 days. Notice that if no advantage, the markets go down. Would buying an inverse ETF be a play? I would not necessarily say no advantage, they go down. Let me show you an example. No advantage means no advantage. Means there's no way to know what's going to happen. So now there's some cases where, like, you could make, like I said on Friday, you could make a case that there could be a short, right? You could make a case, but not strong enough for me to say that. Let me show you an example of when there was no advantage. So no advantage, no advantage. I'm just going to type this in. No advantage can go either way. So you're really talking about like a Uranus concept. Uranus is, it's unexpected. It's sudden, unexpected. You don't know what's going to happen. So this is an example here. Here's an example here with no advantage, okay, on the first. So this is no advantage. And guess what? The market went up, right? It went up, right? First it goes up, it looks like it's going to go up, and then it goes down. And then you ended up basically right where you started. You see that right there? You actually ended up in a better position. So just by waiting and then getting back in at this spot, you actually did better just to wait for it to come back to an advantage. So, I mean, right now, it definitely looks like, it may want to head lower for the next couple of days. It's possible. But it's not enough for me to say I like those odds. And the no advantage is it could go either way. Now, that's just how I do it with those two together. All right, any questions? Any more questions? All right, so questions, no more questions. All right, so we are pushing over an hour here. Thanks. Oh, no problem, guys. No problem. My pleasure. All right, guys, so thanks for joining us again today for our weekly adventure in the stock market. I know this one was a little bit more academic and long-winded, but I think it's important. So the reason it's important is that you understand the role that the Fed plays, and that this is a good thing for the markets ultimately, and it's good for our trading because we can understand when we have these advantages. And so, like, again, this Fed stuff, it didn't exist before 2009. So this is a whole new world that we're dealing with, and so this is why I'm trying to bring this to you guys. And anyway, so I think with that, guys, I'm going to sign out. And again, thank you so much. And keep those questions coming. I really appreciate the feedback, positive or negative. It helps me understand how you guys are thinking and what's helpful and where we can go next in the future. And I think there's a very good future ahead for all of us here. So, all right, guys. So that's all I got for this video. Thanks so much for watching, and I will talk to you next week. Take care.